$500 feels like nothing when you're thinking about retirement. Let me show you what it actually is. $500 invested today at the historical average market return of 7% per year becomes $7,484 in 40 years. That's without adding a single additional dollar. Add $50 per month? That $500 starting point plus $50 monthly becomes $131,000 in 40 years. The question is never whether to start. The question is where and what. Today I'm going to answer both. Specifically, the first decision is which type of account to open. This matters because different accounts have different tax treatment, and tax treatment dramatically affects your outcome over 30 years. If you're starting with $500 and don't have a Roth IRA yet, open one. This is account priority number 1 for most people under 50 earning under $161,000. A Roth IRA lets your $500 grow completely tax-free. When you withdraw in retirement, no tax. Ever. On any of the gains. Open it at Fidelity. Not because Fidelity is paying me to say that, but because Fidelity offers $0 minimum funds, $0 account fees, and the best zero expense ratio funds available. The account takes 10 minutes to open online. If your employer offers a 401k match and you're not getting the full match yet, do that first. Employer match is a guaranteed 50 to 100% return on day one. Nothing else competes with that. After the match, Roth IRA. After the Roth IRA max, back to the 401k. The portfolio I would build with $500 is called a 3-fund portfolio. It was popularized by John Bogle, the founder of Vanguard, and it outperforms the vast majority of professional portfolio managers over any 20-plus year period. 3 funds. That's it. Fund 1, U.S. Total Stock Market. This gives you exposure to every publicly traded company in America, about 3,500 companies in a single fund. If the U.S. economy grows over the next 30 years, you benefit proportionally. Fund 2, International Stock Market. The U.S. is about 60% of global stock market value. The other 40%, Europe, Asia, emerging markets, diversifies your geographic risk. Fund 3, Bonds. These dampen volatility. When stocks drop 30%, bonds typically drop much less. They're a stabilizer. At your age and risk tolerance, you may want less of these. Here are the exact funds. Write these down. If you're at Fidelity. U.S. Market, FCROX, Fidelity Zero Total Market, Expense Ratio, 0%. International, Silks, Fidelity Zero International, Expense Ratio, 0%. Bonds IFXNAX, Fidelity U.S. Bond Index, Expense Ratio, 0.025%. 0% expense ratio on the main 2. That is not a typo. Free. If you're at Vanguard. U.S. Market, VTI, Expense Ratio, 0.03%. International, VXUS, Expense Ratio, 0.07%. Bonds, BND, Expense Ratio, 0.03%. If you're using M1 Finance, you can buy fractions of any of these, which matters when you're starting with $500. What percentage in each? Use this framework. If you're under 35, 80% US, 15% international, 5% bonds. If you're 35 to 50, 70% US, 20% international, 10% bonds. If you're 50 plus, 60% US, 20% international, 20% bonds. The younger you are, the more stock market exposure you want. You have time to ride out downturns. The market has recovered from every single crash in its history. On $500, that's $400 US fund, $75 international, $25 bonds if you're under 35. The most important thing after the initial investment is automation. Set up a monthly automatic investment, whatever amount is realistic. $50. $100. $200. The amount matters less than the consistency.
Dollar cost averaging, investing a fixed amount at fixed intervals regardless of market price, removes timing risk entirely. When markets drop, your fixed amount buys more shares. When they rise, fewer shares. Over time, you accumulate at a blended cost that smooths out volatility. In every major market research study comparing dollar cost averaging to lump sum investing for investors with regular income, dollar cost averaging produces comparable or better results with dramatically lower stress.
Here is the one thing that destroys most first-year investors. They check the portfolio daily. They see it drop 8%. They panic and sell. Every significant market drop in history has been followed by full recovery and new highs. Every single one. The 2020 COVID crash of 34% recovered in 5 months. The investors who lost money in those events were not the ones who held. They were the ones who sold at the bottom. Your job in year one is not to pick stocks. It's not to time the market. It is to automate, ignore, and continue. Most people who invest $500 and see it working naturally ask, what is the right order to invest more? Here is the priority sequence I would use for every additional dollar. Step 1, 401k up to the full employer match. This is your mandatory first move. Every dollar your employer matches is a guaranteed 50 to 100% return on the first day. No index fund in the world competes with that. Step 2, pay off any high-interest debt. If you have credit card debt above 7% interest, paying it off is a guaranteed return equal to that rate. The stock market averages 7% over the long run. You can't reliably beat a guaranteed return by taking market risk. Step 3, max your Roth IRA. The 2026 limit is $7,000 per year, $583 per month. This is the most powerful tax-advantaged account most people will ever access. Step 4, max your 401k up to the annual limit. In 2026 that's $23,500. Most people never reach this. But if you do, it's still the right next move. Step 5, taxable brokerage account. Same 3-fund portfolio. No tax shelter, but no limits either. The reason for this specific order is tax efficiency. Every dollar you can shelter from taxes grows significantly faster than the same dollar in a taxable account. The order matters as much as the amount. One more question you will face: when do you rebalance? As markets move, your portfolio proportions drift. The US market might grow from 80% to 88% of your portfolio. Your international allocation shrinks relatively. This is not a problem you need to solve constantly. The simplest approach, once per year, on your portfolio's anniversary, look at your percentages. If any are more than 5 percentage points from your target, rebalance back. Sell some of what has grown most, buy more of what is underweight. This does 2 things. It maintains your intended risk level. And it mechanically enforces the principle of buying low and selling high without any market timing decisions. $500 is not nothing. $500 is the beginning of a system. A system that, if you leave it alone and add to it consistently, will likely be one of the best financial decisions you ever make. The question is not whether you have enough to start. You do. The question is only when. Next video, once you have this foundation, the exact tax strategies that let that money grow with zero interference from the IRS. That's right here.